One evening, after finishing their work, Nilkanth and Nand met at their usual cafe. As they waited for their coffee, Nand noticed a news report on television discussing rising gold prices. Nand said, "Nilkanth, I often hear people talking about investing in gold and silver. Our parents and grandparents always valued them, but why do they still make sense as investments today?" Nilkanth smiled and stirred his coffee.
That's a great question, Nand. To understand this, think about what money is supposed to do. It should not only help us buy things today, but also preserve our purchasing power for the future. What do you mean by preserving purchasing power? Imagine you kept 1 lakh rupees in cash at home for 10 years. Due to inflation, the same amount would buy much less in the future than it does today. Gold and silver have historically helped people protect their wealth against inflation.
So, gold and silver act as a shield against rising prices?
Exactly. When the value of money falls, precious metals often retain their value better than cash. That's one reason investors around the world keep a portion of their wealth in gold and silver. Nand listened carefully. Are there any other reasons? Yes. Think about uncertainty. Economic slowdowns, market crashes, geopolitical tensions, or financial crises can create fear in the markets. During such times, many investors move toward assets they perceive as safe, and gold is often one of them.
So, gold provides stability when other investments become volatile?
That's right. It may not always deliver the highest returns, but it can help reduce overall portfolio risk. This is called diversification.
And what about silver?
Silver is unique because it has 2 sources of demand. People buy it as a precious metal, but industries also use it in electronics, solar panels, medical equipment, and many modern technologies. As technology grows, silver demand can increase.
Interesting. So, silver benefits from both investment demand and industrial demand.
Exactly. That's why many investors choose to own a combination of gold and silver, rather than relying on only one metal.
After taking a sip of coffee, Nilkanth continued. Let me give you a simple example. Imagine your entire wealth is invested in shares. If the stock market falls sharply, your portfolio could decline significantly. But if you also own some gold and silver, they may help balance the impact. Like having multiple pillars supporting a building instead of just one. Perfect analogy. Diversification doesn't eliminate risk, but it helps manage it. Nand said, "Does that mean I should put all my savings into gold and silver?" Nilkanth laughed. Not at all. Gold and silver are valuable components of a portfolio, but they should complement other investments, such as equity, debt, and emergency savings. The goal is balance, not concentration. Nand nodded. Now I understand. Gold and silver are not just shiny metals. They help protect wealth, provide diversification, and offer stability during uncertain times. Nilkanth said, "Exactly. Investing is not only about maximizing returns, it's also about preserving wealth and managing risk. Gold and silver have played that role for centuries." Nilkanth continued, "Nand, personally, I do not consider gold to be a true investment in the conventional sense. Investments generally create value, generate income, or contribute to economic growth. Gold, on the other hand, mostly serves as a store of wealth. Its real utility comes when it is eventually used for consumption, especially in the form of jewelry. The only major exception is during extreme situations, such as wars or global emergencies, when gold may become one of the few assets accepted across borders as a medium of exchange. Outside such rare scenarios, its primary purpose remains consumption, rather than wealth generation. Consider a situation where Avika is planning to purchase a 10-gram gold coin. The prevailing market price of 24-karat gold, 99.99% purity, is rupees 1.50 lakh per 10 grams. However, the amount she ultimately pays will be higher than the gold value itself because jewelers generally charge making charges and GST.
the total cost would be calculated as follows. 10-gram gold, 24 karat, 99.99% purity, of rupees 1.50 lakh. Making charges, 6% of gold value of rupees 9,000. GST at 3% of rupees 4,770. Total amount payable of rupees 1.63770. Therefore, although the market value of the gold is rupees 1.50 lakh, Avika would actually have to pay rupees 1.63770 to purchase a 10-gram gold coin of 99.99% purity from a jeweler. This means the acquisition cost is approximately 9.18% higher than the prevailing gold price due to making charges and taxes.
Let us assume that by the year 2030, the price of a 10-gram gold coin has increased to rupees 2 lakh. Considering that gold has historically delivered a long-term average return of around 7% to 9% per annum, such a price appreciation is quite possible. At first glance, it may appear that Avika has earned a profit of rupees 50,000, calculated as follows: rupees 2 lakh minus rupees 1,50,000 equals rupees 50,000, where rupees 1,50,000 was the prevailing gold price when she originally purchased the coin. However, the actual amount realized by Avika may be different. When a jeweler buys back a gold coin, the valuation is generally based only on the gold content and purity of the coin. The making charges and GST paid at the time of purchase are not considered part of the gold's resale value because these expenses do not add to the intrinsic value of the metal. Therefore, although Avika paid 1,637,770 rupees at the time of purchase, including making charges and GST, the jeweler will typically consider only the value of the gold while determining the buyback price. Further, if Avika wishes to sell the gold coin for cash, the jeweler may apply a small deduction as a buyback, handling, or melting charge, which can reduce the final amount she receives. On the other hand, if Avika chooses to exchange the gold coin for jewelry, many jewelers may offer the full gold value without any deduction, subject to their exchange policy. In such cases, the value of the gold coin is adjusted against the purchase price of the new jewelry.
Nand thought for a moment and then said, "So if the price of a 10-gram gold coin rises to 2 million rupees, Avika has earned a profit of $36,230 because she originally paid 1,637,000 rupees for the coin." Nilkanth smiled and replied, "Not quite, Nand. The profit is not as straightforward as it appears." He continued, "Now comes the reality. Suppose Avika's objective was ultimately to purchase jewelry for personal use. By the time she is ready to buy the jewelry, the price of gold has also increased to 2 million rupees per 10 grams. Although the value of her gold coin has risen to 2 million rupees, the jewelry she wishes to purchase has become proportionately more expensive as well." Nand nodded as he began to understand.
Nilkanth explained further. Many people look at the numbers and believe they have made a profit of rupees $36,230, calculated as the difference between the current gold value of 2 lakh and the original amount paid of rupees $1,63,770. However, this perceived profit largely disappears when the gold is used to buy jewelry, because the jewelry is now being purchased at the higher prevailing gold price. In other words, he continued, while the value of the gold coin increased, the cost of the item that Avika intended to buy in the future increased as well. The gold helped her keep pace with rising prices, but it did not necessarily make her significantly wealthier.
Nand smiled and said, "So the real benefit of gold is that it preserves purchasing power." "Exactly," replied Nilkanth. "That is why I view gold primarily as a store of value rather than a wealth-creating investment. Gold can help protect the purchasing power of money over long periods and act as a hedge against inflation. In many cases, buying gold today is similar to locking in a portion of your future purchasing power." He concluded, "For this reason, gold should not be viewed solely as an investment for generating returns. Instead, it should be viewed as a tool for preserving wealth and ensuring that the money you save today retains its ability to buy goods and services in the future."
In India,
Many people believe that gold prices always go up. While there is some truth to this belief, it is important to understand why gold tends to appreciate over time. Gold is widely regarded as an inflation hedge. This means that rather than creating substantial new wealth, gold helps preserve the purchasing power of your money. As inflation pushes up the cost of goods and services, the price of gold often rises as well, allowing your savings to keep pace with increasing prices. Thus, gold's primary benefit lies in protecting wealth rather than generating extraordinary returns.
Nilkanth added, I once came across an interesting statistic on Wikipedia. According to the data, India's annual inflation rate was 6.95% in 2023. More importantly, when we look at the longer-term picture, inflation in India has averaged around 7.37% per year between 1960 and 2023. During this period, inflation reached an all-time high of 28.60% in 1974, while the lowest recorded rate was negative 7.63% in 1976. He continued, these figures remind us that inflation has been a persistent part of India's economic history. Although the rate fluctuates from year to year, the long-term trend shows that the purchasing power of money gradually declines over time. This is one of the key reasons why investors often look for assets such as gold, which can help preserve purchasing power over the long run. Considering the above-mentioned figure, it is safe to assume that the inflation in India historically was in the range of 7 to 8%. As per my estimate, for a general middle class, the inflation is around 10 to 15%. Therefore, if you keep your cash in gold, your value of money will remain constant, but there is no growth, as gold do not yield any return, and long-term average return of gold is around 7 to 9% annual. The key takeaway here is that while official inflation may hover around 7 to 8%, the real-world impact on daily life for typical households can be significantly higher. Nilkanth then brought the conversation to the long-term returns of gold versus inflation in India. Both have historically moved in a roughly similar range of 7 to 9% annually. Nilkanth asked Nand to open his laptop and pull up the long-term monthly gold price chart in US dollar terms. After studying the chart for a few moments, Nand said, I don't really understand what this chart signifies. The price seems to move up and down all the time. Nilkanth smiled and replied, don't worry about every rise and fall or what the chart is saying from one point to another. Instead, focus on the long-term trend. The real lesson is not in the short-term fluctuations, but in the broader pattern that unfolds over many years. He then pointed to different sections of the chart and continued, can you see that gold has performed exceptionally well in recent years? However, it has not always moved like this. There have been long periods when gold delivered very little return, followed by periods of strong appreciation. Nand looked more carefully at the chart. Nilkanth continued, that is why it's important to understand that gold's returns tend to come in cycles or blocks. There are phases when prices remain relatively flat for several years, and there are phases when prices rise rapidly. Investors who only look at recent performance often assume that gold always generates high returns, but the historical chart tells a different story. He concluded, the key takeaway is that gold should be viewed over long periods. Its journey is not a smooth upward line. Instead, it moves through extended periods of consolidation, followed by periods of significant gains, as illustrated in the charts. Nilkanth continued, now let us examine what the long-term gold chart in US dollar terms is really telling us. Observations from the gold price chart from 1972 to June 2026. 1972 to 1980, strong bull market. During this period, gold experienced a remarkable upward trend. The price of gold increased approximately 14-fold, making it one of the strongest bull markets in gold's history. Investors who held gold throughout this period enjoyed exceptional returns. 1980 to 2006, extended period of consolidation. After the sharp rise of the 1970s, gold entered a long period of stagnation.
For nearly 26 years, gold delivered little to no overall return to investors who bought near the 1980 peak and simply held their investment. However, investors who accumulated gold gradually through systematic investment plans, SIPs, could have benefited by purchasing at lower prices throughout this extended consolidation phase. 2006 to 2011, another powerful uptrend. Gold once again entered a strong bull market. During these years, the price approximately tripled, rewarding investors who had accumulated gold during the preceding consolidation period. 2011 to 2020, second major consolidation phase. Following the strong gains of 2006 to 2011, gold spent almost a decade moving largely sideways. Similar to the 1980 to 2006 period, long-term returns were limited for investors who purchased near the highs. Once again, SIP investors had opportunities to accumulate gold at varying price levels. 2020 to January 2026, renewed uptrend. Gold resumed its upward trajectory, driven by economic uncertainty, inflation concerns, and increased demand for safe haven assets. This period produced significant gains and reinforced gold's reputation as a store of value during uncertain times. After January 2026, emerging downtrend. The chart indicates that after reaching a major peak in early 2026, gold entered a corrective phase and began trending downward. Whether this develops into a short-term correction or a longer period of consolidation remains to be seen. Nilkanth concluded, the most important lesson is that gold does not generate returns in a smooth and consistent manner. Instead, it tends to move through long cycles.
Nilkanth then asked Nand to open the long-term gold price chart in Indian rupees. As the chart appeared on the screen, Nilkanth smiled and said, "Now the picture becomes even more interesting. Earlier, we looked at gold in US dollar terms. Let us now see how gold has behaved for an Indian investor." Nand looked at the chart and noticed that the trend appeared much stronger than the dollar-denominated chart.
Nilkanth then asked Nand to open the long-term gold price chart in Indian rupees. As the chart appeared on the screen, Nilkanth smiled and said, "Now the picture becomes even more interesting. Earlier, we looked at gold in US dollar terms. Let us now see how gold has behaved for an Indian investor." Nand looked at the chart and noticed that the trend appeared much stronger than the dollar-denominated chart.
Nilkanth explained, that is because an Indian investor benefits from two factors. First, the movement in international gold prices. Second, the long-term depreciation of the Indian rupee against the US dollar. When both factors work together, the price of gold in rupees can rise much more than the price of gold in dollars. He pointed toward the chart and continued, "This is one of the reasons why many Indians believe that gold always goes up. From their perspective, they are looking at gold in rupee terms, not dollar terms. Over long periods, inflation and currency depreciation have contributed significantly to the rise of gold prices in India."
Nand nodded thoughtfully. Nilkanth continued, "However, the same lesson still applies. Even in rupee terms, gold does not rise in a straight line. There are periods of rapid appreciation and periods of consolidation. Investors who focus only on recent gains often miss the fact that gold can remain stagnant for many years before the next major uptrend begins." He concluded, "The key takeaway is that gold's long-term performance in India reflects not only the value of gold itself, but also the declining purchasing power of the rupee over time. That is why gold serves primarily as a store of value and an inflation hedge, helping preserve wealth across generations."
Further, Nilkanth added, "Another important factor is the long-term appreciation of the US dollar against the Indian rupee. Historically, the rupee has depreciated against the dollar by roughly 3% per year on average over long periods. Since gold is priced internationally in US dollars, any appreciation of the dollar automatically translates into higher gold prices when converted into rupees. As a result, gold prices in India often appear to rise more consistently than gold prices in dollar terms. Even when international gold prices are moving sideways or experiencing moderate declines, the depreciation of the rupee can offset part of the decline, limiting the downside in domestic gold prices. Observations from the gold price chart, India. 1995 to 2006, gradual uptrend. During this period, gold prices in India moved upward steadily, although the rate of appreciation was relatively modest. Investors benefited from positive returns, but the gains accumulated slowly over time. 2006 to 2012, strong bull market. This was one of the most powerful bull markets for gold. During these years, gold prices approximately tripled, driven by rising international gold prices, strong investment demand, and global economic uncertainty. 2012 to 2019, extended consolidation phase. Following the sharp rally, gold entered a prolonged consolidation phase. Investors who purchased near the highs earned little overall return during this period. However, investors accumulating gold through systematic investment plans, SIPs, benefited by purchasing at various price levels throughout the consolidation. 2020 to January 2026, renewed uptrend. Gold resumed its upward trajectory, supported by inflation concerns, economic uncertainty, geopolitical tensions, and increased demand for safe haven assets. This period generated substantial gains and reinforced gold's reputation as a store of value during uncertain times. After January 2026, emerging downtrend. After reaching a significant peak in early 2026, gold entered a corrective phase and began trending lower. Whether this marks a temporary correction within a longer-term uptrend or the beginning of an extended consolidation phase remains uncertain and will become clearer with time. Nilkanth concluded, the long-term chart demonstrates that gold does not generate returns in a smooth and predictable manner. Instead, it moves through cycles of appreciation and consolidation. For Indian investors, the combination of international gold prices, strong domestic demand, inflation, and the gradual depreciation of the rupee has made gold an effective store of value over long periods. Its primary role is not necessarily to create extraordinary wealth, but to preserve purchasing power and protect wealth across generations.
Nilkanth teaches Nand the below-mentioned lessons. Accumulate the gold when the gold is in consolidation, not moving anywhere, or the prices of gold are falling. Sell the gold when gold has crossed its previous highs and when the sentiment of the gold at an all-time high. Don't sell the gold at one high, but sell a portion every time when gold has made new higher high compared to the previous high. Always remember, gold is an inflation hedge or protection from uncertainty. Therefore, when the economy is in a downturn, gold prices will rise, and when there is a recovery in economic cycle, businesses, the prices of gold will consolidate or falls.
After understanding the role of gold as a store of value and an inflation hedge, Nand asked, Nilkanth, what are the different ways an investor can gain exposure to gold? Nilkanth replied, there are several ways to invest in gold, and each method has its own advantages and disadvantages. 1. Physical gold. Physical gold can be purchased from jewelers in the form of coins, bars, or jewelry. However, investors should remember that the total cost is higher than the market value of gold because making charges, typically 5 to 6%, and GST, 3%, are added to the price of the metal. Nilkanth explained, physical gold is the most tangible form of ownership. You directly own the asset and do not depend on any financial institution. For many investors, this makes it one of the safest and most trusted ways to hold gold. However, storage, security, and transaction costs should also be considered. 2. Gold exchange-traded funds, or gold ETFs. Gold ETFs can be purchased through a demat and trading account, just like shares. The ETF units are designed to closely track the market price of gold. Most gold ETFs hold physical gold as the underlying asset and issue units against those holdings. Gold ETFs provide convenience, Nilkanth said. You do not have to worry about storage or purity. The only cost is the fund's expense ratio, which generally ranges between 0.5% and 1% per year, depending on the fund house.
1. Gold mutual funds. Gold mutual funds typically invest in gold ETFs rather than directly holding physical gold. As a result, investors indirectly gain exposure to gold through the ETF structure. Nilkanth cautioned, Before investing, it is important to examine the fund's portfolio and investment strategy. Since these funds usually invest through ETFs, they introduce an additional layer between the investor and the underlying gold. Although they provide convenience, investors should understand the structure, expenses, and any applicable exit load before investing.
Sovereign gold bonds, SGBs. Sovereign gold bonds are government-backed securities linked to the price of gold. They were designed to provide investors with exposure to gold without the need to hold the physical metal. Nilkanth added, while SGBs have certain advantages, investors should be aware of liquidity considerations. The investment is intended for a longer holding period, and exiting before maturity may depend on market liquidity. Therefore, SGBs may not be suitable for investors who require easy access to their money or frequent trading flexibility.
Which option should an investor choose? Nilkanth concluded, the choice depends on the investor's objective. If you want physical ownership, physical gold may be appropriate. If convenience, liquidity, and ease of trading are important, gold ETFs are often preferred. Gold mutual funds can be useful for investors who wish to invest through SIPs without maintaining a demat account. SGBs may suit long-term investors who are comfortable with lower liquidity. He smiled and said, remember, the purpose of gold is not merely to generate returns. Its primary role is to preserve purchasing power, provide diversification, and offer protection during periods of uncertainty.
As the evening discussion came to an end, Nand looked thoughtfully at Nilkanth. Nilkanth, today I learned that gold should be viewed more as protection than as an investment. But I still have one question. If gold is so valuable, why do some investors also buy silver? Nilkanth smiled and took a sip of his coffee. That is an excellent question, Nand. Many investors assume that gold and silver serve the same purpose because both are precious metals. In reality, they behave very differently and play different roles in a portfolio. Understanding these differences can help an investor make better decisions. Nand nodded. I have also heard people talk about something called the gold-to-silver ratio. What does that mean? Nilkanth said, understanding how the ratio works requires a deeper discussion. He gathered his notes and stood up. In the next part, we will explore why investment in gold is different from investment in silver, how the gold-to-silver ratio is calculated, what it tells investors, and how it can be used to make smarter investment decisions. Nand smiled eagerly.